So it's 3:30. So welcome those who have been on. You've already heard a lot of the chatter, but I just wanted to welcome everybody. My name is Robert Zabbia. For those of that you don't know me, I own the Zabbia Insurance Agency. We're a family-owned agency here in Massapequa. I work with a lot of realtors, small business owners right here in Nassau and Suffolk and even in the boroughs. And a lot of people have been coming to me asking us about these different things with the loan. I've been seeing a lot of misinformation out there with this bailout and the CARE Act and the payroll protection, the Paycheck Protection Program, and how it's going to affect you. So Roy Breitenbach is my attorney. He handles our human resources legal work here. He put together my handbook, our job descriptions, making sure we're staying compliant with everything with our employees to make sure that they're healthy and happy and safe. So Roy and I were speaking, and he mentioned that this is something that him and his firm have been watching and paying attention to, and they've been diving into the act and a lot of their clients. Roy does a lot with employee on the employer side, so a lot of the stuff with the employees. Specializes in healthcare, but even if you're not in healthcare, as I said, he took care of my needs with updating our handbook and our practices here with everything that's changing constantly. So Roy agreed to do this webinar to share the information that his firm has put together. So this presentation here, you'll see Roy put together. And just a little plug, Roy and I are both in the ABA, the American Business Associates. It's not really a networking group, but it's an association to help develop businesses, and we develop relationships like this where we all work together, and that's how Roy and I met. And we've been doing business now for a couple of years. I've referred several of my associates to him, and they've been very happy. So he definitely is somebody who has a knowledge of handling employment practices. So Roy, what I figure we'll do is you can go through the presentation, give everybody the overview. If anybody has any questions, there's a Q&A on your screen. You just click on that. It should be, I think, right below at the bottom of the, there's a little green arrow and it says Q&A. If you just type that into that, you can ask questions and we'll answer those either live so everybody can hear them, or we'll do it through the chat. So Roy, again, thank you so much for stepping up and doing this. This is a very, very odd time. I've been through 9/11. I've been through 2008. I've been through Hurricane Sandy. I've never seen anything like this. And people are really scared, and a lot of businesses are just trying to figure out how they're going to survive. And this is a very important way to do that. And we want to make sure that we're helping people out as much as we can. So Roy, the floor is yours. So go ahead and get it started.
All right, thank you very much, Rob, for this opportunity. Really appreciate it. Happy to share whatever knowledge I have. Let me play lawyer right at the start and just say, this law was just passed on March 27th, which is last Friday. So it's less than a week old. Everybody's kind of been diving into it and trying to figure out what it means. And usually before these programs get implemented, the regulating agencies, in this case, the SBA, if this was normal times, would have spent a couple of months drafting detailed regulations, policies, and procedures to guide everybody about how the program is going to work and how the lender should operate and everything else. That's not happening here. And as a result, we're kind of all flying seat of the pants. So I'll give you what the overview of the law is. I'm going to talk about how it interplays with a few other issues regarding employment now. The whole concept of this, as you'll see as we get into it, is really to encourage small businesses to not lay off their workers, and if they have, to bring them back, to not, if they can, reduce compensation for their workers, and if they have, to restore those compensation levels. So I'll talk about this, and I'll talk about how it interplays with some of the other recent benefits and the decision to either allow your employees to file for unemployment insurance, to furlough them, and how that all interplays with all of this. So if you can go to the next slide, Rob. Okay, so the this is all part of the CARES Act. There's somebody in Congress whose sole job is to come up with cute acronyms for everything. And the acronym here is CARES. It stands for Coronavirus Aid, Relief, and Economic Security Act. As I said, it was passed into law last Friday, March 27th. It was signed by President Trump on that day. And the main thing that we're going to talk about and focus on is something called the Paycheck Protection Program. That's really what the focus of it is, and that's the program that's designed for the next 8 weeks or so to encourage small businesses, independent contractors, the self-employed, to maintain their payroll, to not reduce compensation, and to keep their headcounts up. There's also some enhanced insurance benefits, which is interesting as a matter of policy because they kind of work at cross purposes with a little bit of the paycheck protection stuff. So, but I think that there was a general sense of Congress that you had to include that because there are people really hurting, and if they can't take advantage of the Paycheck Protection Program, there needed to be some enhanced unemployment benefits. This is also the act in which everyone is going to get their personal tax rebates if they qualify, so we'll talk a little bit about that. There's something that really hasn't gotten a lot of play, but is going to be helpful for a lot of people, which is some retirement fund relief that I'll touch on briefly. And there's a payroll tax deferral. So for businesses, they can deter some of their payroll taxes for the next couple of years on the theory that it'll give more working capital for the business. So let's go to the next slide, Ralph. Okay, so let's talk about the Paycheck Protection Program. That's what we're really here to talk about, right? So it's an SBA loan, Small Business Administration, that helps small businesses keep their workforce employed during the coronavirus crisis. That's its intent. It has no other real intent. It's geared towards that. It's kind of, although we call it a loan, it'll functionally work as a grant if you comply with its provisions, and that's its sole purpose. It will be forgiven. The amounts will be forgiven that you're laying out in the next couple of weeks, as long as you use the money for payroll, rent, mortgage interest, or utilities, and you comply with the regulations. It's right now only available until June 30th. It's going to start for small businesses. Applications will start to be taken on Friday, April 3rd. For sole proprietorships and self-employed, the applications aren't going to start to be taken until next Friday, April 10th, but it's only going to run in any event right now through June 30th. Although if you look in the news and how long this crisis is going to go on and how the curve is being delayed and everything, my suspicion is that the program may be extended beyond June 30th. But again, you can't count on it. And Congress appropriated an overall amount of $349 billion for this program. And as we go through this, you'll see that SBA right now believes that the entire program is going to be subscribed or close to it, because there's a trigger in here about when there's oversubscription, there's a couple of things that change, and the SBA is already saying that that's how they're going to approach the program. So $349 billion of money is going to go into everything. So that's a real interesting amount of money. So let's go to the next slide and talk about who can apply. Okay, any small business. According to the SBA, small businesses are businesses with less than 500 employees. Okay, and for purposes of these loans, sole proprietorship, independent contractors, and self-employed persons are considered to be small businesses and do get the benefit of the act. Now, Robin mentioned something to me that is a pretty hot question, which is if you're a real estate agency or some other business in which the people that work for you are primarily classified as independent contractors, can you get the benefit of that? And the answer is yes. And I think that for purposes of the calculations under the program, you'll just be treated, your independent contractors will be treated as the functional equivalent of employees. There's some kind of interesting issues as to how this would all work out. It'll probably be taken care of on regulation, but it's pretty clear that if you're just a business where your business model is to have all independent contractors, you can get the benefit of this. Not-for-profit organizations may also apply for this. So if you're running a non-for-profit organization, a school, a social services agency, you can certainly take the benefit of this. There is in the statute a sense of the Senate, this bill originated in the Senate, that the focus of the SBA should be on getting the money to small businesses. So it's interesting to see how that's going to be accommodated with regard to not-for-profits. Are they going to be told that they have to wait? Their loans are going to be put to the back of the line? Nobody really knows, but the statute clearly allows it. Now, if you're in the hospitality or food industries, you could have more than 500 employees and still qualify for one of these Paycheck Protection Program loans. If you have multiple sites, the SBA will look on it on a site-by-site basis. So if you have a site, let's say you're a Stop and Shop. Well, if that in the aggregate, you may have over 500 employees, but if your individual store has 500 employees or less, then you may be able to get the benefit of this. So that's the concept here. So let's go to the next slide and talk about how to apply. Okay. Any existing SBA, what's known as a 7A lender, which is your traditional small business administration lender, they can certainly do the loan. Any FDIC insured bank or federal credit union will be able to make the loan. Other regulated lenders, once they're approved, will be able to make the loans. Now, that's an interesting issue because everything is so timely with this. Don't know if you go to an other regulated lender, if that other regulated lender will be up and running in time to really make it matter. The recommendation may be, I think, is to go to existing lenders just because they may be able to process you quickly. As I said, lenders can begin processing loan applications this Friday from small businesses and next Friday from independent contractors and the self-employed. And then finally, there are expedited and simplified processes for processing the loan, and they commit to a 60-day turnaround. It's my hope, because everything here is so time sensitive, that they're going to process the loans a lot quicker than 60 days.
So Roy, one of the things I wanted to jump in right there is there's been a big misunderstanding between independent contractors and small businesses. So from my understanding, it's not how you get paid. So like my agency gets a 1099 from Allstate, but I'm a corporation. So I'm under that first group because I'm an S Corp, correct?
Correct. Yes.
So if you're let's say I know realtors who run under LLCs, is that also, those would be considered under that first group?
That is the case. I think okay. It's pretty clear to me that you're a small business, so your traditional businesses are small businesses and sole proprietorships if you operate and run an actual business, okay? Certainly if you're self-employed, if it's just you go out and you're self-employed, you're in the self-employed, you're in the second group. If you're an independent contractor, is virtually the equivalent of being self-employed. It may be if you incorporate yourself, but you don't get any, but you really don't have any other customer or clients except one entity, things like that. Really, that's where it is. There's not real true definitions in the statute, but that's basically where it should break down. The only difference it makes is on when you apply. Everything else from this point forward will be, the same for everything. So that's really doesn't matter other than for that purpose. So let's go to the next slide.
Okay.
Okay. So big question is, how much can you borrow? And this is going to be the first section that comes up with the concept of how the SBA and the Paycheck Protection Program defines the word payroll. And that's going to be a recurrent theme throughout this entire process, okay? So how much you can borrow is 2.5 times your average monthly payroll. The measuring period is 1 year before the loan is made. So let's say the loan is made at the end of April. They'll go back to April of last year. For the preceding 12 months, they'll take your average monthly payroll. They'll take that average monthly payroll, multiply it by 2.5, and that's the maximum amount you can take out for a loan. So that's why we say that you can see that the concept is to give you 8 weeks of basically ability to pay your payroll through this loan, because 8 weeks is approximately 2.5. And there's other things they're baking into the payroll that you could also use this for. So that's kind of where we are.
So it's 2.5 times your payroll, but you can use it for things like your rent and your
Yes.
interest, not your mortgage principal, but your interest, from what I understand.
Correct.
Your benefits, your health insurance benefits you pay for your staff.
Right, and that's an important point. As long as also to pay your rent, your lease, as long as those obligations, the mortgage and the rent and the lease were entered into prior to February 15th of 2020. They don't want you to go out and get an expensive lease now and use the money for that. So
or hire a bunch of staff and then try to put it through.
Yeah, so it had to have been in existence on February 15th. As long as that's the case, you're okay. Now, there is one other thing, and we'll talk about it later, but I'll mention now as part of this. There's a forgiveness, and that's a little complicated, but as long as you follow certain rules, a lot of what they're laying out now in the loan, there's going to be a forgiveness, so you don't have to pay it back as long as you're using it for payroll and some of these designated expenses. The one thing that the SBA has said is that if the loans are oversubscribed, they're going to have a 25% rule, that you can only use 25% of the loan proceeds for non-payroll related expenses. And if you exceed that, then that's going to impact on their willingness to forgive the loan. So clearly what they're trying to say and what their policy is that for every dollar they give you, they want 75 cents of that dollar to go to payroll. And if you follow kind of that principle, you'll be okay.
Okay. Now, I don't know if you get that into this in further, but if I have somebody, let's say, that was planning on leaving, I'll use myself as an example. I have somebody who's moving to South Carolina. They bought a house, they got married, they're going to be leaving. So that's not going to harm me because she's voluntarily leaving, and I'm probably going to have to hire somebody in her place anyway. So as long as it doesn't go by the people, it goes by the dollars.
Correct. Goes by the head count. For the forgiveness, and we'll talk about this later, they do a head count comparison. As long as your head count is the same, or if it went down, you rehired the people and you brought it back up by June 30th, you're okay. All right. So they're not looking at the individual people per se. They're looking at the head count. And again, if you go back to the purpose of this, which sometimes is the best way to look at these things, is to kind of cut through everything, look at the purpose. It's to keep people working, to encourage people to keep their payrolls up. So that's why the provisions are the way they are. Okay, so now let's talk about what the definition of payroll is, right? Salaries, wages, commissions, which is an interesting issue, and we'll have to talk about that later, about the concept of there's a thing about forgiveness if your pay goes down. But for real estate agents, it's interesting because you got a couple of big sales last year. Should that penalize you for getting it this year? We'll have to talk about that. And similar compensation, cash tips, vacation pay, and sick and family leave. And that's something we should talk about. The week before Congress passed this statute, the CARES Act, there was the Family First Coronavirus Relief Act that was passed. And it has provisions in it, I'll talk about them a little later, about sick pay and family leave. Okay? And under those provisions, the mandated businesses to pay out certain amounts of money in sick pay and family leave pay if you had a coronavirus qualifying condition. As part of that statute, there are tax credits that businesses can use to finance those payments. So what essentially is Congress is saying, there's no double dipping, okay? You have to exclude from the definition of payroll for purposes of these paycheck protection loans any amount you paid under this paid family, you're paying under this paid sick leave and paid family leave, because it's another program that's paying you back for that. No double dipping. And that's, if you follow that concept that there's no double dipping with another federal program, it all makes sense. So Also would include severance pay you may have paid, health insurance premiums, and other group health care benefits, retirement pay, and state and local taxes assessed on the compensation of employees. Okay, let's go to the next slide. Okay, now, here's what we talked about when we first got on. There are exclusions from compensation, right? You can't count compensation as a definition of payroll, any compensation that exceeds an annual salary of $100,000. So, for example, if somebody is making more than $100,000, any payroll that's 1/12 of that for that average, that's computing that average, that exceeds $100,000 is out. For example, if you're making $120,000, the amount of salary that goes into that monthly average is not 1/12 of that, $10,000, but roughly $8,000 because that's 1/12 of 100. So anything that you're going to pay your employees above an annual rate of $100,000 gets excluded from the definition of payroll under this statute. Okay,
That's
so
important because I've heard from some that they exclude the 100,000 totally, but what your interpretation is that only up to the 100,000, which would be the 8,000 a month, not the 12,000 a month that they were making, or 10,000.
right. So when you're calculating your average monthly payroll, you include everybody, but just that the highly compensated you only figure them up to the $100,000 rate. So, and that's because in the 2008 and 2009 bailouts, there were a lot of political issues over the money's being used to pay highly compensated executives. So that's the concept there, right?
Right.
Also excluded from payroll are the qualified sick and family leave wages for which credit is allowed. We just talked about that. And there's an overall loan cap of $10 million. The most that they will lend under this program is $10 million. But, as you can imagine, you have to be a pretty big small business to have over, if you're paid 2.5 times your payroll for the 8 weeks is going to be that amount of money. Okay, so let's now go and talk about the definition for sole proprietors and self-employed, which is on the next slide.
And Cynthia, you asked this question about, do you need some quarter certificate? Some of these questions that we're getting on the Q&A, I'm kind of waiting because I know that they're going to get answered. So if you're asking stuff, we'll get to the end, but some of these are going to get answered right in between.
Yeah, no, you don't need any type of certificate or LLC. I mean, because the sole proprietorship falls within the definition and goes the first week, this Friday. So you don't need any type of that. I mean, I think that when you're applying for the loan, they may want to see how you're organized, the bank, but you shouldn't need anything like that to get the loan.
So basically what the banks have been telling me is to get your 1099 certificates together, get your tax returns for the past couple of years, your payroll statements if you have staff. Those are the kind of things that they've been asking for. Nobody's been asking me for a proof of corporation or anything.
Right. And the key thing that you're going to have to remember for all of this is they're going to want to see your payroll records for the last year, okay? Because so much under this is geared to the payroll that is a absolute must. So you're going to have to show your payroll to the SBA, to an SBA lender. So you have to be comfortable with that, okay? Now, theoretically, they're going to keep it private. There's not going to be any issues with that, but just know that going in, that's the number one thing that they're going to want to see, okay? So the definition of payroll for sole proprietors and the self-employed would obviously include wages, commissions, income, or net earnings from self-employment. Okay, so kind of standard things you would expect. And it's capped at $100,000 on an annualized basis. So if you're, a self-employed, self-insured, self-employed or sole proprietor, they're only going to look at your first $100,000 in that period.
Now, somebody said that they heard that it was just February to June that they're looking for.
Meaning February to June.
From last February to June's reports
No,
That's what
that's
the
only
banks might be asking for, right?
if you're a new business, they could look for only that period. Okay, if you're a new business that you weren't in existence last year, they have the ability to look at February through June. Whether some banks are taking that more to go quicker, I don't know, but the statute clearly says they look at last year's.
Okay.
Because they
Yeah,
have to.
I've heard Matt's just saying that he heard from an SBA lender, they just want February to June. But Matt, I've heard both from two different SBA lenders. I've heard, yeah, they want February to June. I've heard they want the whole year. And February 15th is the cutoff for this year, correct?
Right. Now, the other thing is that they're going to need at some point. Now, it may be this, okay? It may be that this is what some lenders are doing. Some lenders are saying, show me only a few months now to get the process started. But for purposes of forgiveness, they're going to have to go back and look at what you did last year. So, I assume they're going to ultimately ask for the records. They may, at the beginning, may only be looking at a certain number of records, but they're going to ultimately, you're going to have to show them everything.
Right.
Because the forgiveness is keyed off of last year.
I've had SBA lenders ask me for 3 years worth of tax returns. So I mean,
Right.
we're getting all kinds of information.
It's going to depend again. Usually what happens in these situations, all this stuff is done by regulation, and the lenders know exactly what the SBA is looking for and what they need. It's going to be a total seat of the pants. Some banks who are particularly conservative and who are nervous about the SBA rejecting guarantees because they're not properly documented, maybe over-requiring information, you don't know. So let's go to the next one, which is borrower requirements. Okay.
And when somebody asks, is that the fiscal year or is it, so if you don't run January to December, is it your fiscal year or?
So what they have said is they're going to look at payroll for the same year period the prior year. So if they're so you get it for the 8 weeks, they go back and look at the 8 weeks, the same 8 weeks last year. So it's that last year's period, right? So it's not necessarily fiscal year, it's going back last year. Okay? It's going back for that same, it's over the last 12 months. So it goes back to last February 15th is how the best way to phrase it is.
Okay, that's what I've heard, pretty consistently.
Right. So for purposes of the forgiveness, it's you look at the same period that you got the loan last year. For purposes of how they're calculating the average monthly, it's the preceding 12-month period. So they're not concerned about fiscal year. They're concerned about what you've done over the last year. They're going to want to calculate what your average payroll was for a month.
Right.
So, okay, borrower requirements. You're going to have to sign a good faith certificate that the loan was needed because of COVID-19 economic uncertainty, and will be used to maintain payroll and make required payments. So, that's their hook, that if you don't do that, then there's going to be issues. So, just be aware of that.
Right.
And you also have to certify that the borrower is not receiving duplicative funds from the same uses from another SBA program. That means that there's no double dipping. There is no collateral or personal guarantees required. And as we've been talking about, this need to make payroll, to provide payroll documents.
And that's why a lot of the banks I'm talking to are concerned, and they might be a little bit more looking at things a little bit closer than the SBA might, because they're worried that they're going to be on the hook if they don't document all this stuff.
Yep. So let's go down now to the next slide. Now, there's a little bit of confusion on this. If you go to the SBA website, they're talking about much shorter maturity dates and much lower interest rates. But what we've confirmed, when we've talked to lenders, some of my partners, that that there is a maximum provision, and that the lenders are going to go, make determinations based upon what they normally do. That the maximum loan maturity date that are allowed is 10 years, and the maximum interest rate is 4%. Okay. The loan payments, though, will be deferred for anywhere from 6 to 12 months. Those deferments are supposed to be given as a matter of course, and is designed to give everybody breathing room. And neither the government nor the lenders are going to be able to charge small businesses or sole proprietorships, independent contractors, self-employed, any fees in connection with this loan. So, so really the interest rate and the loan maturity and the amount of deferral is all within the discretion of the lender. Theoretically, the SBA will be providing them with guidelines, but you know, it's a standard bank thing. The more creditworthy you are, you're going to get more favorable terms. Same as any other thing, but it's within these bandwidths here. Maturity up to 10 years, interest rate up to 4%, deferral up to 12 months. All right, so let's go to the next slide. Okay, what you can use the loan for. Payroll costs, what they really want you to use the loan for. Group health care benefits, so you can pay your health insurance premiums. Other insurance premiums, which everybody's wondering what that truly means, okay? Interest, but not principal, incurred on debt before February 15th of 2020, which is what we talked about, right? As long as you've taken out the mortgage, the business loan, or whatever, before February 15th, you can use the loan to pay off the interest. Rent on any lease that's been enforced prior to February 15th of 2020. So, you know, based upon what our clients are talking to us about, the number one thing after payroll that businesses are looking to use the proceeds of this loan for are leases. Okay, is rental payments. So that's a big benefit. And utility payments, right? Although some of the the utilities, I think, are all having programs where they're deferring monthly stuff as a result of the crisis. But just be aware, you know, that if you have to, you can use it for utility payments. Okay, so let's go to the next slide. Which
so, Roy, I might have missed it. I was answering a question online, but Matt brought up the question that the SBA lender says credit doesn't matter, which is what I've heard.
Right.
But did you say that credit is a?
But what I'm saying is that the amount of the length of the loan you're going to get, the amount of interest rate is still, you know, how are the banks going to base that on? They're going to base that on a variety of different factors. I don't know if one of them is going to be credit, but credit worthiness is not a factor in getting the loan. If you have bad credit, you're going to get a loan. Is that going to be taken into account and giving you an interest rate of, you know, 3% versus 4% versus 2%? Nobody really knows. But for purposes of getting the loan, they're not going to look at credit score, credit worthiness, anything else. You're going to get the loan. Okay? They may vary some of the terms within the bands, but you're going to get the loan.
Okay.
Okay, so payroll has the same definition as in the loan amount provisions. What this means is you can't use the loan proceeds to pay employees at a rate that exceeds $100,000, right? So if you have employees that make more than $100,000 a year, you can't pay them at a higher rate that would exceed the $100,000 rate for the 8-week period. So that's pretty clear. You can't use loan proceeds for payroll taxes, income taxes, or compensation of non-U.S. resident employees. So I don't know if any of you guys have non-U.S. resident employees, but you can't use it for that at all. And you can't use proceeds for qualified sick leave or family leave wages, for which a credit is allowed under the Families First Coronavirus Response Act. That's the principle of no double dipping, right?
Right.
You want to make sure that there's no double dipping. There's some other statute that does that, okay? All right, let's go to the next slide.
So one of the questions I just got, which is, since like with the realtors, they're not allowed to work right now. And, you know, in a lot of these restaurants, they can't have table service. So the payroll isn't going to get paid if we're not opened up by June 30th. So how would that apply with the forgive? Because you could still get the loan based on your payroll from last year.
Right.
It's just a matter of whether you're going to get forgiven, or are they going to, or as long as you get the people hired back by the 30th. But your rent alone might, I mean, like in my case, my rent is not, it's not what my payroll is, but it's a significant amount. So at least my rent would be forgiven for the next couple of months, even if I didn't spend all the money on payroll.
Correct. Right. So yes. So yeah. So those are all the calculations that businesses have to make with their accountants, right? And whether or not it makes sense to take this loan. So to the extent that you can't be open, you have to ask yourself, does it make sense to take this benefit, which is geared primarily towards paying payroll, right? Now, Rob, you're correct. In a situation in which you want to pay your rent with it, you got to pay your rent. So you use your rent, you use it to pay your rent. The impact of that, though, would be at the end of the day, when there's the forgiveness provisions, because you're not using it primarily for payroll, you're not going to get the level of forgiveness, if any, for it. So it's just going to be a regular old SBA loan. If you truly use it for payroll, then you are going to get it's essentially a grant. You're essentially going to get they're going to be enabling you to fund your payroll. So it's a question that everybody has to decide for themselves whether it makes sense.
And then the lease, you mentioned the lease. So the lease for the building you might be renting or the storefront is okay. But what about leases for equipment, such as vehicles or tractors or something like that?
I believe if you're using it in the operation of your business, it is acceptable. But that's something, because that would be under the financing agreements, would be similar to that. But that is something that is going to have to be clarified later. Clarified.
So it could be, but you'd have to really talk to your accountant.
Talk to your lender about that.
Right, because like my accountant doesn't want me writing off vehicles, because as an insurance agent, it's not really necessary to have a car.
Right.
So he always looks at it. His term is, well, you can write off whatever you want. It's, can you justify it when you get audited?
Correct. You have to really talk to them about that, because to the extent that you're using the lease as just a financing vehicle for equipment you need for your business, I think that the trend, and when you look at the intent of the statute, it probably should be covered and you should be able to use it for that. But I would definitely talk, if that's a big issue for you and you foresee you having to use it for that purpose, I would definitely talk about that with your lender. Because and get it documented if they tell you it's okay, so you don't have a problem later on.
And the way I look at it is, even if I can't, let's say if I don't know what my numbers are, I haven't sat down, but let's say I get $100,000 and I use 70,000 of it towards my overhead for everything that does qualify, and I still owe 30,000 for a 10-year loan at 4%. It's still a pretty good deal.
Right, and that's the point too. You're right about that. The other thing is that, while it may be hard to do this with commercial leases, it's probably easier to do this with other service agreements and stuff that you have. And even with real estate leases, talk to your landlords and your service providers and your your vendors. You may be able to work out deals with them to alleviate some of the payments in the short term. Most commercial landlords are willing to set, it's our experience, both us as a firm and dealing with clients, that most commercial landlords, sophisticated commercial landlords, are willing to give you a rent abatement for a couple of months at this point.
So here's a really good question. I have a couple of brokers that they get the checks from the sale of the houses, and then they pay their people as 1099 contractors. So the 1099 contractors can be counted in their payroll, even though it's not traditional payroll.
Correct.
But what about the 1099 contractor themselves? Can they also apply for it for themselves?
And that's an interesting issue, and that's a unique issue to like the real estate agent, the real estate agency thing. I think there's no guidance on this. The act doesn't go into this, but there's a couple of issues that, as I was thinking about it with real estate agents, I think are open issues, and that's one of them. I think that the answer is, what my gut tells me is, you can only be counted once for these loans. So you're either counted as an employee or you're counted as somebody taking out the loans. That's what I think. Okay, that seems to make sense to me, and I think that may be when you go through the application process and you have to certify that there's no other program, SBA program, which may be getting relief. That may be one of the things that they're looking to get to find out. I definitely would mention that to your lender up front, because I wouldn't want you to get into trouble with, a false certification or something. That, if you are counted as an employee by, let's say, the brokerage, but then you have employees, can you both be somebody that the brokerage is using for purposes of their SBA loan as an employee, but then also go get it yourself as an employee to pay the wages? I'm not sure about that. I would talk about that with the lender. I haven't seen anything one way or the other on that.
Okay, so that's one of the things we'll have to come back and circle back
Yeah.
on.
I could see it both ways.
I'm sorry?
I said I could see it both ways.
Right.
I could also make an argument that if you have somebody in the nature of an employee to you, why shouldn't you get the loan to pay their payroll?
Right. So let's say if I, I have a client, somebody asked a question here, who's a contractor, and they have no work. So do they have to wait till they get the money? Can they wait till they get the money and then pay them? Or do they have to consistently pay them? As long as they're paying them by June 30th, then they're good, right?
Yes. That is correct.
Okay.
And, one of the things, this is one of the other issues which has kind of been left unstated with this whole thing, which is an interesting question, right? They have 60 days to approve this loan. So if you apply for this loan on Friday, 60 days get you awfully close to the June ending date. So what does that mean? What are they going to do? And that's an interesting issue that I've not seen any clarification on. Are they going to say you're going to retroactive it back to the February 15th date and, show me that if you take it now, go back and pay payroll? I don't know. There's a lot of issues with that. Because what happens if you don't get the money until May 15th, let's say? There's all kinds of issues. Suppose you decide to hire people back, can you use it to reimburse you for that payroll? Those are all kinds of questions that are unanswered as of now. So, like, for example, if I now apply for the loan tomorrow, I don't know I have it, let's say until May 1st. I pay out, my out of my own pocket, I pay my workers their salary through May 1st. Can I now, when I get the loan, put that, take the proceeds to pay those back wages? Reimburse me for paying the wages? Probably not, but that's a very unknown issue at the present time.
And if they collect unemployment in the meantime, that's really not being looked at as long as the money's being spent. They're not really they're looking at the money that you spent, not necessarily their money that's coming in.
Yes.
And that also goes back to like the realtors. Normally a realtor wouldn't be able to collect unemployment unless they're incorporated in paying unemployment insurance. But now with this new legislation, they can collect under that.
They can get it for the purposes, they come under there's a pandemic unemployment allowance, and they come under those provisions.
Gotcha.
Yes. Yeah. Okay, so let's go now to the next slide. Loan forgiveness. Okay, loan recipients are eligible for loan forgiveness for 8-week period starting on loan origination. So, once the loan starts, anything you pay in that next 8-week period is forgiven for purposes of, as long as you do it for one of the dedicated reasons, okay? Here's what it is. Payroll costs, again, $100,000 limit. So you can't go over whatever the rate would be during an 8-week period for $100,000 a year employee. Payment of interest on mortgage obligations, rent obligations, and utility payments. So for those things, you will get forgiven. The amount of your forgiveness cannot exceed the amount borrowed. And I can't wrap my hand around how that would be the case. Where
don't expect another check if you spend $100,000.
Yeah, exactly. But I assume that there is a way that that works out. That's why they put it in there.
Gotcha.
All right, so let's go to the next slide.
So one of the questions is can they prepay rent?
Right, and those are a lot of different issues that we don't know.
Okay.
Yeah, exactly right. Good question. Don't know. You know, my suggestion on all of these unknowable questions right now is talk to your lender. And when they tell you to do something that's not exactly the letter of the law or not exactly what it says, get it from them in writing. So if anyone ever comes back, you have something in documentation, okay? So now here's where it gets complicated, and this is the thing that's been misstated in a lot of the different places. There is a loan forgiveness reduction and limitation. So the presumption is anything you pay in payroll costs for that 8-week period is forgiven, okay? However, they're going to look at your average number of employees during that 8-week period, okay? And they're also going to go back and look at it in the same period in 2019, okay? So if you had more employees in 2019 than you have during the measuring period in 2020, they're going to reduce your forgiveness by that percentage. So if you had 10 employees during the measuring period in 2019, but only have 5 employees now, you only get 50% of the forgiveness that you would otherwise be entitled to for payroll.
Okay.
So that's the theory. So essentially what they're doing is they're encouraging you to keep the same payroll for this 8-week period, the same employee census, than for the 8-week period last year. Now, what happens if you've let people go already? That's okay. However, as long as you rehire them by June 30th. So if you could show that, okay, my census at the start of the period, of this 8-week period that's going to start now, is low, but by June 30th, I've rehired everybody, they're going to consider them as being in that 8-week period for purposes of 2020. So it's encouraging you to either maintain the same payroll or close to the same payroll and census that you had in 2019 for this 8-week period, or if you don't at the start of the period, to bring people back so that you hit that, okay? So that's the concept. And the kind of the concept that goes along with that is if your payroll goes down more than 25% from the 8-week period last year to the 8-week period this year, the amount that exceeds 25% is a reduction on your forgiveness. So if you had $100,000 of payroll costs in 2019 and you had only $50,000 in 2020, that exceeds that's a 50%, so that exceeds the cap by 25%. So your loan forgiveness is limited by the 25%.
So you can still get the loan, and it's just that you're only going to get forgiven 50%, and then you'll have to pay off the rest over the 10-year period.
Yes, that's exactly what it means. So that's the deal. So so now it's interesting. It's not entirely clear whether if you have a lower payroll, if both happen, how they're going to do that. They're going to double penalize you. It's a question. The other issue is that I have a huge issue about this for real estate agents, because if you had a lot of big commissions that came in that period in 2019 that you don't have now, how does that come into play? Right?
Yeah, that's one of the questions I had, because somebody said that, well, they're not, they're going to reopen, but they're not going to have any money coming in for months after this, because the closing process takes 2 or 3 months with all the stuff with all the courts closed down and the clerk's offices. So we reopen on May 1st. There's no checks coming in until July 1st for the realtors.
Right. So that's why, I think the answer to that question is, now this is just my opinion. So I've not seen this anyplace, but I think this is the answer. I think it's the most logical answer, which is you may have to make a case when you go and you talk about the forgiveness with your banker, that the commissions that you earned in 2019 should be excluded, on the theory that, you can't be expected to keep up the same commission level.
Right. Yeah, because if we're closed down, there's going to be some commission checks, as we do have some closings going on now and maybe a couple more in April. But after that, there's not going to be any closings in May.
Right.
There's no showings going on. There's no, like I said, a lot of the clerk's offices, so they can't do title searches. So it's going to be very difficult to show, keeping, especially for realtors and the brokers, to show them, they're not going to pay their salespeople if they're not selling anything. So that'll be tough to get the forgiveness. So they're really, you're not probably going to be getting forgiveness on this stuff as much as just floating the money and then having a really low interest rate to pay over the 10-year period.
Now, I would for like a real estate agency, I would talk to the banker about those circumstances, because some of those things, this is intended to make you try to increase your payroll and keep your salary level stable.
Right.
If there's circumstances beyond your control, and I think for the real estate industry, you can certainly come up with circumstances beyond your control, like Rob just cited, okay? I think you can make an argument to your lender as to why you shouldn't be penalized on the 25% reduction.
All right, so we only have 9 more minutes. I forgot how many more slides.
Yeah, I have a bunch more slides, which we can talk about. But let me just talk about specifically. There's going to be a 25% forgiven amount for okay, so essentially, if the program is oversubscribed, and it's probably going to be oversubscribed, you can't use more than 25% of your forgiven amount for non-payroll costs.
So 25% can be used for your rent or interest on the mortgage that you carry.
Right.
What about interest on, so the contractor, Kim, she asked, what about the interest on materials from the supply houses? Because they haven't been paid by the clients because the work's not done yet.
Yeah, I don't think that's going to be in there, but I don't know.
Don't know. Okay, so that's something that we'll have to circle back and ask the lenders. Okay.
Okay, so going to the next slide. There's also an economic injury disaster loan that SBA is giving out. You may have already gotten it. If you got it between January 31st and today, you can refinance it into a Paycheck Protection Program loan and get all these benefits. But you can't now take out a new EIDL and payroll protection at the same time. And some people have received what's known as an EIDL $10,000 grant. If you've gotten that, that gets subtracted from the amount that they're going to forgive under the Paycheck Protection Program. So again, the whole principle of no double dipping.
All right, let's get to the, because a lot of questions are coming in about the unemployment.
Yeah, I'm going to go all the way. If you want to go to that, it's at the back of the slide. I'll tell you the slide number. It's the last few slides.
Well, let's go to this one, the direct payment of taxpayers. Somebody asked that.
Sure.
So one of the questions was, did you have to file your 2019 taxes yet to get that?
No, if you don't have your 2019 taxes filed, they'll look at it on the basis of 2018.
But if you don't, so I was actually reading in the paper today that if you don't file taxes normally because your income's too low, you're still going to have to file in order to get it, though.
Correct.
Okay.
Right. They want you. Yeah, it's a requirement of filing taxes. Yeah, it's.
And the $1,200 is a check or direct deposit. It's not a credit on your tax return.
Correct.
Okay.
And it's actually income to you, believe it or not. You have to report it as income.
Oh, do you?
I don't understand.
But the loan you don't have to.
What?
But the loan you don't have to.
The loan you don't have to do. Ordinarily, that's another point. It's a good point to make about the loan. Ordinarily, whenever there's loan forgiveness, the amount that a loan is forgiven has to be reported on your income taxes as income.
Right.
Okay? That there's a specific statute provision as part of the Paycheck Protection Program that says that you do not have to pay taxes on the forgiven amount.
So I'm going to just jump ahead to the.
Should be right after that. furlough after that, reduction in hours. Here you
So
go.
this is the one that a lot of people are asking about. So,
So,
as the owner of the business, now I know me, I pay for unemployment insurance on myself. And it's funny, my accountant always would joke with me. He goes, yeah, you have to pay it even though you wouldn't fire yourself. But
right,
this is the perfect example of why
correct,
a business owner has to pay for their own unemployment.
correct,
So in this case, they would be able to apply if they're not taking a check.
correct. So there's an enhanced unemployment insurance that the federal government it's part of the CARES Act. Okay, it expands eligibility, and I'll talk about that in the context of New York. It provides an additional $600 weekly benefit for 4 months over and above what the state program will provide. I'll explain how it works in a couple of slides. And it also automatically extends the caps for insurance, unemployment insurance benefits and stuff to the end of the year. And it also broadens the definition, as Rob just said, to the self-employed, independent contractors, and gig economy workers. So it's a real good benefit. So let's go to the next slide, which will talk about it specifically in the context of New York. So New York, so now you have to make a distinction between those traditionally able to receive unemployment insurance and those who are not. Those who are not traditionally able to receive unemployment insurance include the self-employed, independent contractors, and workers with limited work history. They traditionally have not been able to get unemployment insurance. Let's go to the next slide and see how it works. Okay, so for traditional eligibles, people who are traditionally eligible, you're going to be entitled to 39 weeks of unemployment insurance benefits, and you're going to get an additional $600 a week over and above what you would ordinarily get under the state benefit, under the formula based upon your wages, from April 5th through July 31st of 2020. So let's go to the next slide. Traditional ineligibles, people who are self-employed, independent contractors, gig economy workers. If you can't work because of COVID-19 related issues, okay, you're then entitled to pandemic unemployment assistance. So if you could show, and as a whole, if you go on the Department of Labor website, under pandemic unemployment assistance, there's a poster and it will show you all of the things. And it's basically any reason you can think of why you're not working or getting income because of the pandemic, such as can't get to your office, can't have to stay at home to watch the kids, a whole host of issues, very broad. You are going to get 39 weeks of benefits plus an additional $600 a week for the April 5th through July 31st, 2020. So you are going to get essentially the same unemployment benefit as a traditional eligible would get. So let's go to the next slide. If you've exhausted your benefits after July 1st, so for example, you may have been unemployed prior to that, you've exhausted your 26 weeks. Traditionally, you get 26 weeks of unemployment. You now get an additional 13 weeks of benefits, and you get the additional $600 for the April 5th through July 31st period. So basically, you can come back into unemployment. If you already exhausted your 26 weeks after July 1st of 2019, you can now come back and you can get the additional 13 weeks of benefits. The important thing also to remember, and it's on a slide previously, a lot of businesses are cutting hours and compensation for their employees. If that's your case, if you fall below the definition of what constitutes a part-time employee for purposes of the unemployment insurance compensation provisions in New York, you're entitled to unemployment insurance if you're a part-time employee. The rule is you have to work less than 4 days a week and made less than, it's in the slides at the right section, you can look it up. It's less than about $500 for a week. You can, at that point, get unemployment insurance for just being forced to go down to part-time. So that's another benefit that you can get. So even if you're now going to be a part-time worker, you can get unemployment insurance.
One of the questions I have is if you already had the employees went out on unemployment because you were shut down, so you stopped paying them, and they started collecting it, and then you apply for the loan, as long as you hire them back by the 30th, then you'll still be able to get part of that loan forgiven.
Correct.
And they won't have to give back the money because that they collected on unemployment.
They collected unemployment. They were out of work.
Right.
Right. Right.
And then how do they calculate the benefits if you're a 1099? I would assume they would just average it.
I would assume that's a question that's the unemployment regulations, I would assume. And the other thing that a lot of business owners are asking, it's all well and good to have this unemployment, these expanded unemployment benefits, but unemployment is an insurance program. And does that mean that my unemployment insurance premiums are going to go up?
Of course they are. Come on.
Well, the official statements by the federal government is that the answer is unlikely, not significantly, because there's all kinds of federal relief to support the states in the expanded insurance benefits.
So the maximum unemployment that's paid by the state right now is $504. So you're going to add another $600, so it's $1,100.
Correct.
$4 a week is the max.
Yes.
And you would have to just show that you average that if you're on a 1099 and only get paid once a month or every other month or something like that.
They're good, but again, the only thing I'm going to say about unemployment, I saw in today's paper that New York State has said that the amount of people that have reached out to them to file claims have increased in the last month over 16,000%.
Yeah.
So, I'm not sure how efficient that system is going to be.
Now, somebody said the $1,200 stimulus check, just going back to that their CPA said it will not be taxed.
Okay, they have said it's taxable income, so that's what I've seen. So,
the legislation says right now that that $1,200 is taxable.
Taxable income.
Okay. And then somebody asked, so as an owner, I can do this loan for the PPP and collect unemployment because I'm out of work, because I'm not collecting any money because my business was one of the ones that was shut down. Or is that completely separate?
So it's an interesting question, which I don't know the answer to, because I think you probably would be able to do it.
But that's something you'd have to check with the bank, probably.
You check with the bank, and you would also have to talk to unemployment insurance, because that's an interesting issue, whether or not you would be able to do that. Because
and if you already applied for one of the other loans, you said you can convert that to this loan, correct?
You applied for an economic injury disaster loan after related to coronavirus after January, I think it's January 31st of 2020. You could have them convert that to a Paycheck Protection Program loan, and when they do that, you'll get all the benefits of the statute.
Okay. And then the maximum amount that could be borrowed is 2.5 times your payroll.
Correct.
So if you're a 1099 sole proprietor, I guess it's 2.5 times what you pay yourself.
Yes. Well,
up to $100,000 max.
Yes. Right.
So
right. Yes.
If you're making $1 million a year, you're only going to be able to borrow the $8,000 a month for the 8 weeks.
Correct. Correct. Yeah. And I don't think it's necessarily what you pay. If you look at the definition of payroll for purposes of a sole proprietor or an independent contractor or the self-employed, it talks about the concept of its wages, salaries, earnings, commissions. So, you may be able to convince a banker that, it's the net income coming in, not necessarily just what you're paying yourself. So if you're leaving money in the business historically, you should look at the bigger amount, I think,
okay.
but that's, again, something that you would have to talk to the bankers about.
And if you don't have the money now to pay your staff because of the fact that your business is shut down, you're not really expected to continue to pay them. You can apply for the loan. It's just a matter of how much you pay them by June 30th for that loan to be given.
Yes, right. Exactly right. So the concept
really weigh is that disaster loan a better situation to get yourself back into business.
Yes.
Forgiveness versus doing this with some forgiveness.
Correct. Yes. You should talk to your accountants and your CFOs and your financial people and model all this out. In other words, is it worthwhile to get this loan? knowing that you may not get the forgiveness that you need. Now there's all kinds of issues that go into that, right?
And as a real estate salesperson, independent contractor, basically you fit in under this because you're a sole proprietor. You'll have to apply for the loan on the 10th instead of the 3rd, and it'll be based on your 1099. So get your tax returns, 1099 statements. I would also get your average monthly paychecks that you got or commission checks that you got from last year, from February to June, to have that as to be ready for the bank. And the banks might have more information that they might require, but have all the banks I'm talking to, they want your tax returns for the past 3 years. They want your 941s for your payroll taxes for last year, and they're also going to want to see any of your other expenses that would be covered, such as your overhead, rent, stuff like that. Yes, Kim, you can pay only 6 of your employees instead of the 12, but when you go for the loan forgiveness, it may only give you the forgiveness on 50% of that. Correct?
Right, that is correct.
Jack, I love this. Can I deduct the cost of the single malt scotch that I've been going through?
I think that's a necessary business expense.
So on a serious note, Jack, though, wants to know, his daughters are living with him. He's paying for 2 empty apartments in the city. Is there any word on forgiveness?
Yeah, and I have that same sympathy because I'm paying for an apartment in Bridgeport, Connecticut for my daughter for the same thing. There supposedly are bills in the legislature about forgiveness for residential and commercial leases. So I don't know where they are or how far they are, but that is the Law Journal this morning reported that there are bills pending.
And what if one of your employees cannot come back on June 30th because they don't work for the summer? That will count in your employee count. Like I said, I have somebody who's moving on the 17th of April. She's moving down to South Carolina, but I'm going to be replacing her. So as long as I replace her by June, and it's a 75%. So if my payroll and headcount are 75%, then I can still.
Well, no, it's only 75% for the purposes of the compensation. For the purposes for the head count, they say they're going to look at it directly, and if there's a reduction,
okay,
they'll reduce you.
Oh, that's good to know.
I would, obviously in those situations, there's 2 things you could do. Number 1, you could look to hire somebody else to come in, or number 2, make a contention because you're going to file an application at some point for forgiveness, and you're going to have to show all this other stuff, right? So, make a case to your lender that it's unfair to consider to count this in a decrease in census because the person left, for another reason. That's what I would say. Make your case.
All right, cool. So Kim asked, is it better off just to lay them off and put them on unemployment insurance? That's something that you'll have to talk to your accountant.
Yeah, and if you look through the slides for this, you will see, and I can get you if you give your email to Rob, I'll give you the full PowerPoint. There's all kinds of considerations you need to do with furloughs. It may make sense, but you also have to account for such things as, are they getting paid sick leave and paid family leave now, which means that they're job protected? What's it going to mean for their health insurance and benefits and how that impacts you? There's a bunch of different issues that you got to take into account for that. But it may make in certain circumstances sense to furlough employees.
Okay, great. Matt, you're welcome. I'm glad that you're giving us the feedback that you learned a lot on this. I know there's a lot of confusing information. We're doing the best we can. This isn't all 100% because one of the things I've learned about legislation is that after there's legislation, then it's up to the different branches or the different bureaucracies to put in their interpretations of the legislation. So a lot of that stuff, as we learned when they passed the tax laws, a lot of the stuff we didn't know until April 15th of whether you can write things off. So some of this stuff we're not going to really know is going to be forgivable until after we apply for the forgiveness.
Right, exactly. And then SBA will enact regulations that'll put more details on some of these concepts.
Yeah, Jack, we are going to send this presentation. We're going to post this webinar up on Facebook and on LinkedIn. We want to get the word out as much as we can. We will, we might even do another one of these as Roy and I find out more information. We really want to be a resource. We want to be here to help. There's a lot of stuff that's going on that people have no idea, myself included, which is why I reached out to Roy. And Roy was kind enough to take this time and put this together and answer your questions. So again, if there's any of the information isn't 100%, it's because the answers aren't 100% yet. Check with your lender once everything is out on Friday. Check with your accountant and and then go from there. As far as the lenders, we don't know. I guess the SBA might have a list of lenders that are already approved.
I think the SBA website has a list of lenders that are approved. I think you put in your zip code and they tell you, where. I think they were supposed to start that.
All right, good. I would deal with your banker. I have a couple of friends, so I'm talking to all of them. But we're getting a lot of thank yous. So you're welcome. We really appreciate that. And yes, Cynthia, we'll email this out, I think, through and again, this is my first webinar, so hopefully if there's any glitches, I'm sorry, but I believe I do have everybody's email address that came in. So we will email out a copy of the presentation with a link to the video, and we'll get this out to you. So that's it. We're 4:41, so we're 11 minutes over. I want to give Roy the rest of the day to be able to do his stuff. But again, thank you everybody for jumping on. Thank you, Roy.
Thank you very much.
You've been a great asset for my agency and definitely a big help for my clients and the people who I've referred. So I appreciate all that.
Thank you very much.
All right, take care.
Okay, bye-bye.